Let me move by Alex's advice this time. So members, we can start. Today's topic is about business income. Those who never passed the first test that I gave you, please make sure that in this topic you are around, because after this topic I will again give another test. I hear rumors that the government may open schools and institutions on 20th. But me, even if they open on 20th, I will have finished lecturing. I won't meet you in class. Yes, Doreen, we have started. I won't meet you again in live lectures. So I'm finishing everything from here. And even if they open, I will not be having time to meet you so that I explain, do what. We shall not meet again. So let's move on. So members who didn't pass, I can see people got 0 in the last test. Others have 2 out of 10. It was just a startup. It was just a startup test. The next test will be out of 20, and the last one will be out of 15. So it's up to you to make sure that at least you attend. I know most of you are already around in hostels. Some people do not attend, having hopes that maybe people will help them and discuss for them. It is okay. When someone is doing a test on VLA and gets 2, you will always also get 2 because you don't know what he's doing for you. So members, always attend. Business income. According to section 19, subsection 1 of ITA, Income Tax Act 1997, business income refers to any income derived by a person incidental to carrying on or carrying out a business. So in a layman's understanding, the way you hear the word business, also business income comes from a business, whether it is revenue in nature or capital in nature. When I talk of revenue, it is when you are just getting incomes out of stock and sales. But for capital in nature, when you are selling fixed assets and you even get some income out of trading those capital assets, fixed assets. For example, if you are trading in land, for example, if you are trading in houses, that is capital in nature. If you are selling motor vehicles, that is capital in nature. It is the same as business. So business, when you talk of business income, it is that income that we get out of businesses, whether they are revenue in nature. When I talk of revenue in nature, I mean those that you get out of selling and trading stock. When I talk of capital nature, it is that income that you get out of selling fixed assets. So business income includes the following. Whatever you get out of disposal, you have been using an asset and your company is very well registered and this asset has totally depreciated. And when it is totally depreciated, you want to sell it off. After selling it off, you get some income. When you are selling, we call it disposal. When you get some income, then that income must be taxed. So when you are talking of business income, even anything that you get out of the disposal of business assets or sale of stock and then you earn revenue, that is also business income. Also, business income is any amount received by a person as consideration for restricting that person's capacity to carry on business. Sometimes they may compensate you. They may say, we have stopped this business, and the government decides to compensate you. If they compensate you, that what you get is your income. It is also restricted to taxation. And then gross proceeds derived by a person from the disposal of trading stock. I've talked about disposal of assets, capital assets, also stock. You want to get out of the business. For example, you had a shop and you want to get out of business of having a shop. Then what do? You dispose of all that trading stock. The gains you get from the disposal of that stock is income. Members, when I talk of gains, is any extra amount of money you get from how much you had bought it. So if you had bought like a soap, you are trading in soap, you had bought soap at 100,000, you are selling, you have sold your soap, a sabuni at 120,000. That gain you get of 20,000, that is what is taxed, not what you get out exactly. So we tax the gainers, the government taxes the gainers, not what you get out. So when I talk of revenue in nature, it means they are the gains that you get. Members, in this course unit, it goes back to how you studied fundamentals of accounting. If you never got fundamentals of accounting very well, then it will be hard for you to compute business income. Yes, but sir, I'm not hearing anything. Twesday Innocent, unmute, join with audio. Join with audio because others are listening. Then the value of any gift derived by a person by virtue of the past, present, or prospective business relationship. In any case, you had a business relationship some time back and you got some gains and you are enjoying those gains right now. The agreement was done before, but you have got gains today. That is what I call past. Even if the agreement is in the past, but you have got some gains, URA will follow it and tax that gain that you've got. Also present or in the future. We have what we call accruals. And what is the opposite of accruals? Future prospects. Someone may give you income today and you start enjoying it when you have not even given a service. That is what I call future prospects. So if you have some payables, you have already got some money but you have to pay and you have already gained that income, URA would tax it in a business. Interest derived in respect to the trade receivables, person engaged in the business or banking or money. If you have deposited your money in a bank and you get some interest, they have to charge you what you call business income. And that type of income is called withholding tax. And we look at it. So once a business is being operated and it gets some money from the bank, it deposits or fix some money in the bank, they give you some income, interest. They will always charge you what we call business income tax, which we term as withholding tax. But we add all that together. If you have rent, if you are receiving rent or what we call rental income, you have houses, and these houses are giving you some income, you are holding that property, that income is taxed as business income. And lastly, any amount received by a person carrying out business and is not exempt from taxation by ITA. So if you are doing any business and you get any income, this is an open clause that you should never say, though I'm operating the business, the income I've got is not listed into what you have said. No. Once you have a business and what you earn is not listed in ITA 1997, then if it is not exempt, therefore you pay tax. Now, members, I want you to understand that in fundamentals of accounting, you have been looking at how to have reports, how to prepare reports. The reports are income statement and balance sheet. Now, the business which operates and prepares reports must prepare the income statement and the balance sheet. If the tax person comes at your business, if it is not a small business that pays presumptive tax, if you are preparing this every year, you have to prepare your incomes, show your expenditures, get your balance sheet, show your assets. After showing them, then URA will charge you the business income tax. So when I talk of allowable deductions, when you are preparing your income statement, there are those deductions which are allowed to be put in your expenditure and those which are allowed to be put in your income. And there are those which are not allowed to be put in your expenditure when you are preparing the income statement. So if you are preparing the income statement, members, you must be careful. Also the balance sheet. You know, in the balance sheet, we always compute depreciation. And I know you studied that. So if you are computing depreciation, at the end of the day, you have to declare it through expenses and you put it in the expenses. If you put it in the expenses, it means that at the end of the day, it can be allowed or it may not be allowed. So if we are looking at business income, members, I want you to go and understand how income statement is prepared and how balance sheet is prepared in your fundamentals of accounting. We started by sales. We less cost of sales. After listening cost of sales, we get gross profit. We add other incomes. I know when I'm talking, you are also writing because this is what we are going to look at. After adding other incomes, you get gross profit. After getting gross profit, you less other expenses. And these other expenses sometimes are into two, three. We can have administrative expenses, we can have operational expenses, and we can have even other expenses. So when we are preparing this, at the end we get net profit or net surplus. This net surplus we get is what is charged business income. So in those your expenses that when you are preparing your fundamentals, your accounts, when you are preparing your accounts, there are some items that URA allows and say, yeah, this item should be in your income statement. This item should be in your balance sheet. And there are also expenses that URA does not allow. And that's what I call array reductions in business income. This statement says array reductions include all expenditures that were wholly and exclusively incurred in the generation of income under tax assessment for the accounting period under the review. You know, these statements are always prepared periodically. So if you say, me, I operate from this time to this time, so that's what we call accounting under review. So those are the expenses which are allowed to be in your expense or incomes or in your income statement, and they give you revenue. They are revenue in nature. So our reductions include the following. All expenditures and losses incurred by the person to the extent to which those expenditures and losses were incurred in the production of income during the year of income under review. What do I mean here? Our reductions are those expenditures that you spend or you incur when you are operating your businesses. For example, salary, transport, all those expenditures are allowed because there is no way you can operate the business without having those expenditures. So all of them are really allowable. Also, if you make a loss, you were trading, you bought something at 1,000, you sold it at 80,000 and you made a loss. That is also allowable because losses are losses and you had nothing to do. So losses are allowed as expenditures, and also agreed expenditures during operations are also allowed, especially during the year of income, which is under review. Hope members, we are together. I've run faster, but let me go up a bit. So we are talking that any loss on disposal is allowed. Loss from disposal of business asset, yes. Any loss, any loss that you incur when you are disposing of an asset. For example, you bought a motorcycle, it got a lot of challenges and you cannot repair it. You decide to sell it off, yet you are using it trading your mandazi. Take your mandazi or something else and you dispose it off. When you dispose it off, that expense, that loss that you get after selling it, because you bought it at 5 million, but you have sold it at 1 million, that loss is allowed as an expenditure. Expense on meals, refreshment. I told you the other time, if you are eating from the job, we cannot do what you call double taxation. So if you are eating from the job, the company is giving you meals and refreshments because you cannot work without eating. Really, these are allowed. But if you take them home, then we shall follow you as an individual. Then we go back to employment income. And another one, where persons business is the provision of meals, where the person's business is the provision of meals, refreshment, and entertainment. All of them, if we are giving them at job, then like when there is like a DSTV at the place of work, That one we allow because staff have to be entertained, even refreshments and other things. I've talked about expenditure. I'm trying to show you so that when you land on these expenditures in the income statement, please, they are allowed. You will see the kind of questions I'll be giving. Interest expenditure incurred during the year of income in respect to the debt obligation. For example, you took a debt from a certain circle or a certain bank. After taking that debt, you are paying interest on it because you borrowed as part of your capital. When you pay back, that interest is not taxed because you are paying back and you never took it. But the person who takes it, if it is a bank, they will tax it. They will find it the other side. They won't find it this side. Minor capital equipment expenditure, which are less than 100,000, those are also not taxed because they are minor capital expenditures. But those big ones, which are above 1 million, please, they tax them. Legal consultancy, auditing, and other professional fees paid by the person for the service rendered. If you pay all this, you call the auditor, you go to court, all these expenditures are allowed by URA. When I'm talking about this, those who are working in the circles, they understand what I say, what I'm saying. So when we are preparing accounts for returns, before we pay, tax for you, all these expenditures are allowed. Even repairs of property and equipment are also allowed. Even bad debts written off. You gave your money to someone and he failed to pay you. At the end of the day, that bad debt that you have written off is allowed as an expense. So members, I think you are all available here. Those who are here, 115 out of 230, you will see the text that people will get here. So those who are here, I think you are understanding me. I think I can move on. Should I move on? Should I move on? Say yes or no. Just one yes. Are we together, members? Or rain has disturbed you? Aha. Yes, we continue. That is Franklin and other people. Namparita, Rachel Ichirza. Okay, let's continue, members. I think those are enough. People are with us here. Now, members, bad debts to be allowed as a deductible expense. It must be resulted out of the business operations. If you took a debt into your personal activity, you took a debt and do it into your personal activity, make sure that you understand this, because when I'm asking, I have to make sure that you understood this. Sometimes people don't understand. I give a question and someone is asking himself, where does this? So someone may be having a company called like a BO company. He takes a loan, but instead of putting that loan into a business, he buys other things which are not related to the business. Or he gives his money to other person that is not related to the business. If someone doesn't pay you, then that bad debt is not considered as a what? As a bad debt. The business concern must have all the necessary steps to cover. Now, for it to be allowed as a debt written off and as an expense, we must see all the steps you have taken to make sure that that debt is recovered. If you see that you cannot recover, you went to court, you did what, everything failed, then we will allow it as an expense. Where a previous written off debt is recovered, the amount recovered are taken to business income for taxation. So if we had written it off and put it in an expense, at the end of the day, people come and pay you, then that is income. Once it comes back, then it is income. The whole of it, we count it as income, then we shall charge tax out of it. These premiums, which are less than 99 years, are treated as arrival deductions. So if you lease is giving out your asset for a long period of time. So if you give your asset, which is not more than 99 years, and you get some income, then that income or that expense on it is not allowed. Employment remuneration and salaries, that is exact, because this one already we pay as you earn on it. So it is an expense on a company. We allow it, we cannot tax it again. Other allowable expenditures: startup costs, preliminary expenses when you are starting your business and you put in your money. Startup costs, all those startup costs, because you have not made any income, we allow them as expenses. They include costs incurred to enable the entity to come into existence. A deduction is allowable for the startup cost of a rate of 25% on straight line basis over a period of 4 years. So all those startup costs are allowed at 25% over a period of 4 years. So when you make income, after making income of like 2 million, next time you make income of 3 million, we keep on getting 25%, calculating it on straight line basis as an expense when you have started. Then after 4 years, you have to pay everything without deducting 25%. Research is part of startup. Research is part of business development. So scientific research is also allowed. If you do any research, forgive me, sir, to leave because you can go. You can go. I will see out what to do for you. So also research, scientific research expenditure. If you have scientific research expenditure, it is also a deduction. We won't tax it. That expenditure will be allowed. Trainings. If you make trainings, such trainings does not exist on average of 5 years. Such training is provided to a resident person. So this one is given to someone who is in Uganda and was born in Uganda and is a resident person. So such trainings are allowed as expenses. Even on the job, if you are on the job and they just put in some any training, those who are working and on weekend understand what I'm saying. All this is allowed as an expense. We shall see those which are not allowable, which we add back. You had treated as an expense to reduce your net income. Members, the more net income you get, the more tax you will pay. So companies try to reduce taxes they pay by reducing surplus through expenditure. That's why when your array comes, it recounts your expenditure and adds back some items. So we shall see those which are not allowed. Charitable donations. A donation or a gift made during a year of income is allowed as a deduction if such donation or a gift was made to any of the following organizations. So members, if we find that your company has made a donation to religious church, we allow it as an expense. But if you give it to your wife, we cannot allow it as an expense. That is a drawing. Registered charitable organization. For example, if like Compassion International, it is helping needy children, and your company gives it a donation, then we allow as an expenditure. Education or medical institution of a public nature. If you help a school or a hospital, we allow. Amateur sporting association. Those are the associations which develop those people who don't have talents. We allow them as deductions, as expenditure. We are saying that, however, the value of the donation or gift allowed as a deduction should not exceed 5% of business taxable income. So if we compute all of your expenses, we have to multiply by 5%. Compare it with the what? With the donation that you gave. If the donation is above that, the extra is taxed. Members, you must get me very well there. So we have to compare with the surplus. Or someone may say, I gave a donation of 100 million, yet he made an income of 5 million. Can you imagine? We cannot allow that donation because you are doing it to avoid tax. If you get net surplus of 100 million, you must give out donation of only 5 million. Fee subscriptions. Fee subscription made a trade association to which a firm is a member. For example, those who are in circles, or we subscribe to KUSKU, Uganda Cooperative Savings and Credit Union, or we subscribe to UCA, Ghana Cooperative Alliance. So if you subscribe your fees there, or you see, or whatever, central financing, whatever, if you subscribe your money there, then we allow it as an expenditure. Non-allowable expenses. What are those expenses that we don't allow? If you take out your money in your business and go and buy a plot of land, That's what we call drawings. We say, no, this money was supposed to be for the business. Bring it back. We add it back and then tax it. So we don't allow drawings. Fines and penalties. Fines and penalties. When you default and they put for you a fine, you cannot say that I never took that money, it was taken by the other person that I had defaulted. When you fail to pay him in time, we have to tax it. Because why did you default? Why did you pay on time? That is your A. Again, we are talking about capital expenditures. Any expenditure in connection with acquisition of capital asset, renovation, repricing capital assets, as well as any initial capital outlays is not tax allowed. So when you spend on capital, you say I bought a motorcycle, we don't allow those asset capital expenditures in what? In expenses in the income statement. We treat them aside on how when we are preparing property plant and equipment schedule. When we are preparing fixed asset schedule, we put it aside. We do not allow it to be put in the incomes. I hope you remember that in your financial fundamentals of accounting. Recoverable costs, expense that would not appear to be allowed but later to be recovered by the insurance. For example, you made a loss, you lost someone, and someone has a debt with you, but you had put it in insurance, then insurance later pay you, we cannot regard it as a loss because you have recovered it. Government grants by any other outside means, there is no tax benefit that will be received in such circumstances. Domestic or private expenditure. When you take anything out of your business and you buy matoke, you say this matoke I was taking it home, it is mine. I know I had the business in Etekukunde Berra. URA will not allow that. When you are to do that, use the profit. First, get profit for the month, share it, take it away, rather than just getting any money from the drawer and you run away. That's how most of Ugandans prepare. Do their businesses. At any time they come kwataka bora no kushanga business in kweche mtware. He gets it out of the business and donates it like that. We do not allow any domestic private expenditure because we want these businesses to grow. Get some money, put it aside for your family, but not let know that business be used to cater for your family, and at the end of the day, it falls down. So we do not allow any money. Akanaka mtukanje na akahumu kazi. That's what I told you. We do not allow depreciation expenses. I'm going to talk about that. We do not allow all that. We have to add it back. Even contribution made to retirement fund, if you have made contribution to NSSF, we do not allow. We add it back because it will be tax. Let's look at capital deductions also. Now, we don't allow depreciation, members. Since we do not allow depreciation, and most of you prepare income statement, and then you put in your depreciation. When government tax guys come, they don't accept for you to put depreciation. They add it back so that it increases your net income. So when this depreciation is added back, they go and prepare for you what we call capital deductions. They prepare capital deductions. Members, be steady here. In business income tax, we do not allow you to put depreciation in your expenses. We add it back as an income, but instead, we prepare for you what we call capital deductions. We get all your assets, arrange them together, use our own formulas as your A, recount depreciation. So, capital deduction replaces depreciation. Hope we are together there. So, these are deductions in respect for qualifying capital expenditure. And we are saying not all capital deductions or capital expenditures qualify for capital deductions. We shall look at them. So we look at capital. When I talk about capital, I'm talking about fixed assets. So members, in tax, when I talk about capital expenditure, I'm talking about fixed assets. I can even read this like, these are deductions in respect to qualifying fixed assets expenditure. So when I talk about capital expenditure, I'm talking about fixed assets. So the purpose of giving capital deductions is to enable a taxpayer receive a qualifying outlay. We are trying to reduce on you because we have not allowed depreciation. We are trying to reduce on your total net surplus, which will make pay you a lot of tax. And from this, I will tell you that the tax computation for business income has no table like employment income. This time, the tax charge for all business incomes is 30%. It is fixed. So we shall get 30% multiplied by the total net surplus you will get. So if you have a lot of total net surplus, total net income, you will pay more money. If you have little, you will pay more. So we are computing capital deductions because we want to replace this depreciation. That's why I'm saying capital deductions are the equivalent of depreciation. That is why we listed depreciation among the non-allowable deductions so that we can compute allow its equivalent, which is called capital deductions. So we need to move forward and we look at qualifying capital, which are assets that are qualifying for capital deductions. Which assets are those? So we are saying not all capital expenditure qualify, not all fixed assets qualify for capital deductions once you buy them. It is therefore pertinent for us to know that the following are qualifying for capital expenditure. Number one, expenditure on plant and machinery. When you buy a chomachamati, for example, you have a dairy. That's what we call plant and machinery. When you buy any machine used in production, it qualifies for capital expenditure. Number two, what is in capital expenditure? Expenditure on industrial buildings. If you build a building and you put a lot of money in that building, we call it IBD, industrial building allowance. We allow it in expenditure. Expenditure on farm works, you buy a tractor, you buy a bomba, yokufuirira, all those, if your business is agriculture, we allow them as capital expenditures. Expenditure on mining operators, if your company is mining, then we allow. But we say that you need to know that some capital expenses are already allowed expenses and need to be considered for further deduction, e.g. minor capital equipment, cost of intangible assets, and others. So I'm saying if you buy intangible assets like a software, that one, we allow it as an expense. We don't look at it as a capital deduction or a fixed asset expenditure. These which are minor, we shall see the minor expenses on a capital or on fixed assets when we get to the real classification. So, types of capital deductions. On these that I've mentioned, we always compute wear and tear. Wear and tear. Members, wear and tear replaces depreciation. So, wear and tear replaces depreciation. So, we always compute this wear and tear and put it in expenses as an expenditure to reduce on your net surplus so that you don't pay a lot of money. We always go to the building, see your building, and have some percentage that we get from your building as it depreciates. So building does not come in wear and tear. For buildings, we can compute what we call industrial building deduction, which is IBD. I've talked about it. And lastly, when you are acquiring this asset, when you get it for the first time, for the first year, you have not used it. You have not used it. It has not yet produced very well. So we always allow it what we call initial allowance because it is being put in use initially for the first time. So we also get and calculate some percentage. We call it initial allowance and put it in your expense. I've already talked about startup costs. Let me conclude with these members. I'm concluding with this. We have always, we have to always classify our our capitals or our fixed assets. How do we classify them? We classify them into two forms. The ITA or Income Tax Act classified plant and machinery in the first class with different rates as follows. So plant and machinery, whatever you use, this plant and machinery, which is not part of the building, whatever we use, whether computer, whether vehicles, all of them are called plant and machinery. So we put them in 4 classes. Class number 1. Class number 1, note down, it has computers and data handling equipment. So if you have a printer, if you have a photocopier, if you have a computer, we give it class 1, we put it in class 1, and we call it class 1, and then we give it its deduction we give it its deduction, we give it its wear and tear. And the wear and tear for class 1 is 40%. So we put them in classes. We don't just get them together and then charge 40%. We keep on separating them, these fixed assets. So we are saying computers, printers, typewriters, and others, they are in computer data handling equipment. All these data handling equipment and computers are in class 1. And they must be above 1 million. Anything that is below 1 million, we just count it as an expenditure. We just put it there direct. But if it is above 1 million, we take it in that class, we arrange them together, we get them together, we get the total computers you have at the job, all those computers which are above 1 million, we multiply by 40%, we get what we call wear and tear. We take it to your what? To your expenses. Class 2. In class 2, we have automobiles, za boda boda, pichi pichi. We have buses, we have mini buses with a seating capacity of less than 30 passengers. That is class 2. Class 2 and class 3 confuses students. We are saying that in class 2, we have automobiles, which are motor vehicles, buses, mini buses with seating capacity of less than 30 passengers. Goods vehicles with a local capacity or a carrying capacity of less than 70 tons. 7 tons. So members, if you have akamotoka atakatwara abantu and it just only carries 7 tons, it is in class 2 with these mini buses and automobiles and what, which take less than 30 passengers, and we charge 35% as wear and tear. Take in the what? In the income and expenditure, because we want to reduce net surplus, so that when we put in 30%, you don't pay a lot of tax. Class 3, we have buses seating capacity which are above 30%. And carrying capacity, those vehicles which can carry 70 tons and above. Members, when you go back to class 2, change this for me to 70 tons. Less than 70 tons. Then this is above 70 tons. This is not 7 tons. Please change it for me. This is 70 tons. So specialized trucks, trailers, and those which carry other vehicles, plant and machinery used in farming, manufacturing, and mining operations. All these are in class 3. I will give you a question. I will find you a trailer. You are putting it in class 2. Mark all these that I'm talking about. So there are 4 classes. We charge 30% as wear and tear. We take it our what? We take it our income statement to reduce our net surplus so that we can pay less tax. And lastly, class 4. Class 4 has railroad cars, garzomika, locomotives. These are the things that carry things on. You have never you have never seen a ship. I know most of you have never seen even a ferry. So locomotives are these equipments which carry a lot of equipments when they are all stock, when they are brought on what? When they are brought on a ferry or a ship. So all these are in class 4. Vessel barges. These are big machines that bring a lot of what? A lot of equipments in the country, and sometimes they travel on lakes and oceans. Tugs and similar water transportation equipment. Ebyenyonyi, wagwetu motoka chenyonyi. Or some of you can buy an aeroplane in your business. It is also in class 4. Specialized public utility plant. Those that we cannot put anywhere. They are specialized. You have made it for yourself because you want that machinery. But be careful because in this class, all the questions I've asked in this class 4, they always relate to furniture and fittings and small equipments in the office like a stapling machine and others which are above 1 million. So furniture and fittings members are in this class. So AB, when I'm asking about this question, I may not get a company which uses all the above that I've talked about. However, office furniture, fixtures and fittings are in this class and we charge it 20%. Mark that, members. When we come back, we shall immediately start from there. Members, I know you have been following. If you have any question, you can send me a chat or let me unmute you and then you ask a question if you never understood anywhere. Members, unmute yourself. I've also unmuted you. Unmute yourself and ask something so that we end the lecture of today. Edman is saying thanks, sir, for that day's lecture. Commission Christian, thanks for the lecture. We appreciate. May Almighty God bless you too, Christian. But when you add percentage of class 1, 2, 3, B, and 4, it exceeds 100%. Ignore the 100%. Those classes, their percentages do not add up to 100%, which is just a charge in that class. We are not caring whether it is 100%. That is how it was set by URA. Mine is thank you. That is Brea. Thanks. Atire, thanks for the lecture. Into some more explanation on class 2. Class 2, go and read about class 2 qualifying capital expenditure. I've talked about class 2. We are saying class 2, it has automobiles, buses, minibuses with seating capacity of less than 30 people or 30 passengers, and also those which carry tons which are less than 70%, not 7% as you read it there. Luz Command is saying pardon. Pardon on income and expenditure. You have forgotten how you studied it in your income and expenditure account, especially income statement that you studied in fundamentals. When we come to practical computations, I will explain about that. Thanks, Alicia. Why is retirement fund contribution not an allowable deduction? It is not allowable. Some more explanation if some explanation about why retirement fund is not allowable deduction. Remember, we first get gross salary of a person. When we get gross salary, we charge what we call pay as you earn or employment income. So it is already charged in gross income or gross salary of an employee. We charge it payee. We charge it employment income. So once it is already charged employment income, then it is an expense in the company's books of accounts because it is already charged from the other side of an individual. Yes, Ime, I think I have explained very well. If there is no person who has a question, I can see other people are appreciating. If there's no thanks, sir. If there's no other person, members, I have today recorded this because most people have been affected by the network. So for today, I've decided to record for your revision. Immediately after I've put it off, I will post the link on WhatsApp. When you click on that link, you will be able to watch today's lecture. There's no need of going on VRA. I will try and put on VRA, VRE, sorry. I'll try and put on VRE, but also on your WhatsApp, I'll try and send it there. Is capital deduction the same as discount received? No, capital deduction is a deduction of fixed asset. Discount received, that is also an income for the company and is charged tax. Thank you very much, Doreen. I've read your comment. I wish you. Ongom David is saying, advice, master. The class 1 for where? I have not understood your question, Mr. Ongom. You're perfect, sir, but Put it on WhatsApp. Yes, I will put it on WhatsApp. The recording of today, I will put it on WhatsApp. Why is that expensive property is having low rate than the cheap one? Because you have answered yourself, Mr. Alex, because they are expensive. You have already spent a lot of money on that expensive asset. Now it has to be given a little or a smaller deduction rate than the smaller ones. Are reductions deducted from gross income before taxing it? Yes, they are deducted from gross income to get the net surplus. Thank you very much, Jovita, for that question. Okay, people have understood. Allow me to end the lecture of today. What is non-taxable income, sir? Non-taxable income. That is Kakuru Peter. Non-taxable income is that income that you get but that does not qualify to be taxed. And I've given a lot of examples, Mr. Kakuru Peter. When we come to examples and computation, you will understand what I have said and what I've been saying. In theory, you may not understand well, but let's get computation and calculations. I know you'll understand very well. Someone is talking? I wish you a good night and a good evening, members. Namanya Patience, you are talking.
Thank you.
Yes, Kaugo.
I was saying welcome. Yes, sir.
Yes, please.
I was wishing you a good evening.
Kale, good evening too. We meet next time when we shall have a test. I will communicate.